Hi, welcome to the video. This is part 3 for your chapter 4. So in this section, we are going to learn the accounting of bonus issue, dividend, and what is the advantages and disadvantages for limited liability company. So accounting of bonus issue. What is bonus issue? Bonus issues are free shares. Free, it means that no money, free, to the existing shareholder of company. Bonus issues are generally issued by profit-making company by capitalizing the reserve to ordinary share capital of the company. There is no cash received from the shareholder, and the company net worth will not have any impact. So basically, the company, when we know that when the company make money, right? So when the company make profit, the profit will goes to retained earning. Am I right? So what is bonus issue? Bonus issues is use the retained earning and distribute to the shareholder, and this bonus issues is FOC, free of charge. No amount will be received from the shareholder. So let's take a look. What is the advantages and disadvantages of bonus issue? Advantages of bonus issue: market will have positive view on company during the announcement of bonus issue, as this is an indication that the company is making profit. Next, a channel of reward existing shareholder without the outflow of cash. Disadvantages: no cash received from bonus issue, no changes in the company net worth after bonus issue, and affecting the ability of future dividend payment as reserve being capitalized as share capital. So next, I'm going to show one example of bonus issue, and we see whether the company net worth or the equity has any changes before and after the bonus issue. So let's take a look on this exercise. Classroom exercise 4.5. SWP Limited excuse me, has million ordinary share at the par value of $1 each. The management decides to give bonus issue to existing shareholder at the basis of one share, one bonus issue for every 5 existing share held. The bonus issue are utilizing the share premium, which amounted to 600,000 before the bonus issue take place. So we have to calculate how much of bonus issue that we are given to our shareholder. So originally we have 1 million ordinary share. We have 1 million ordinary share, and the basics of giving bonus issue is if you have 5 share, I give you 1 ordinary share. So divided by 5, multiply by 1. Every 5 share, I give you 1. So how much of the ordinary share, how much of the bonus issue? 200,000. And now we have to provide the accounting entry for bonus issue. So normally when we issue share, we debit bank or debit cash, right? So in this situation, we cannot debit bank. Why? Because we did not receive anything. Alright, so basically bonus issue is transfer the share premium to the ordinary share. So the double entry will be like this. We debit the share premium because your share premium will become lesser after the transfer, and we credit to ordinary share capital. So how much? 200,000. Why 200,000? Because we use 200,000 bonus share times 1. This is the par value. So let's take a look. What is the structure of the company equity before and after the bonus issue? So before bonus issue, the company is having 1 million share, ordinary share capital 1 million also, because the par value is 1 per share. Share premium 600,000 before the bonus issue, so 1.6 million. Take note, this is unit, this is dollar, this is dollar. So the total equity, we use 1 million plus 600,000. Next, bonus issue. Bonus issues will increase the company numbers of share by 200,000. The value of ordinary share increased by 200,000 as well. However, this amount is utilizing the share premium, so no changes. One positive 200,000, one negative 200,000, so the net impact is 0. And lastly, after bonus issue, share capital in numbers increased to 1.2 million, ordinary share value 1.2 million as well, share premium 400,000, and your total equity 1.6 million, so no changes. So basically, we look at before and after bonus issue. You can tell that there is no changes in the company equity. So from here, we can understand that bonus issues will not increase the company net worth because there is no cash received from the shareholder after the issues. So this is the example for your bonus issue. And the exercise 4.6, we will practice in the live section. So let's continue. Next one, dividend. What is dividend? I think we explained in the previous section, right? Dividend. Dividend is a distribution of company profit to its shareholder. The payment of dividend must be approved by board of directors. Additionally, the management shall ensure sufficient revenue reserve available for distribution of dividend, meaning that the payment of dividend cannot exceed the revenue reserve. So basically, your dividend amount must less than your revenue reserve. Your dividend payment must less than your dividend reserve. You cannot pay more than your revenue reserve. The computation of dividend can be based on per share or percentage. We have two ways to calculate. We base on per share, which is by unit, or based on the percentage by the monetary value of the shares. Types of dividend. We have two types of dividend. First is interim dividend. Dividend declared and paid by company in any day of the year, except for financial statement last date. Next one, final dividend. Dividend proposed by the company at the end of the financial year. The final dividend will usually declare and paid in the next financial year. According to IAS 10 events after reporting period, a proposed final dividend shall not be recorded in current financial year. A note to the financial statement is required to disclose the event of final dividend. So let me use a diagram to explain this to you. So imagine the company financial period is from 1st of January up to 31st December. So if the company paid dividend, declared and paid from any date during this period, let's say this is up to 30th, this dividend we call interim dividend. If you have interim dividend, you record in current year. However, if the dividend is only proposed at the last day of the financial year, you propose only. Propose means not yet confirmed. Not yet confirmed, you propose only. So this is called final dividend. For final dividend, we only record in next financial year. I repeat, if the dividend is declared and paid in between the financial year, any day of the financial year, except for the last date, except for the last date. This is called as interim dividend. When you have interim dividends, you have to record in the current financial year account. However, if you only have proposed dividend at the end of the financial year, this one we call final dividend, proposed final dividend, and proposed final dividend we only record in next financial year. So perhaps by doing one example, you can familiar better about this concept. So let's look at the exercise 4.7. So let's take a look on classroom exercise 4.7. CHL Limited has 500,000 ordinary share at the par value of 50 cents at 1st January 2018. On 31st March 2018, the management decides to declare and pay interim dividend of 5 cents per share. On 30th September 2018, the management decided to declare and pay another 3% interim dividend on ordinary shares due to excellent performance. At the end of financial year 31st December 2018, the management proposed a 5% final dividend on ordinary share. Please compute the total of dividend for the financial year 31st December 2018. List not to financial statement if any. So we have to calculate the dividend. The first dividend is declared on 1st January 2018. So how it compute 5 cents per share? So we use 800,000 times 0.05. So we get how much? 40,000. Yes, we get 40,000 of interim dividend. Next payment of dividend is on 30th September 2018. This is based on 3%. So class, when you have a percentage, instead of using the number of share, you also need to include the par value. I repeat, if the dividend is paid by using or is measured by using a percentage, you cannot just only include the number of share in your computation. You shall also include your par value. If you use 800,000 times 3%, you cannot get anything because it's not in a monetary value. But your dividend is in a monetary value, because if it shows a percentage, this percentage refer to your par value of the share. Refer to the par value of the share. So answer 800,000 times 5 cents each times 3%. So it's 12,000. And last one is on 31st December 2018. How it compute? They say propose a 5%. So we use 800,000 times 5 cents each times 5%. So what is the value? So answer is 20,000. So let's take a look on the requirement. Total payment of dividend for the financial year 31st December 2018. This is the requirement. So tell me 1, 2, 3, which one should include as the dividend? The answer is the first one, 1st January, second one, 30th of September. The third one, 31st December 2018, we cannot consider as 2018 dividend payment. Why? Because this is only proposed final dividend. Remember, as per our explanation just now, proposed final dividend cannot record in the current financial year. We shall only record in next year, because this amount is not yet confirmed or finalized within the year. So we can only consider in next financial year. So our total dividend is 40,000 plus 12,000. So we get 52,000. So this is the final answer. And then the question also mentioned that we have to list down the notes to the financial statement, if any. So according to our textbook, for final dividend, you no need record in the account. However, you need to include this information in the notes to financial statement to disclose the event of final dividend. So we write down what is the notes to the financial statement. The management propose a 5% final dividend amounting to 20,000 for the financial year 31st December 2018. Although the proposed final dividend are not required to include in the account, but we have to show in the notes to the financial statement to tell people that this event is happened. The management proposed a 5% final dividend amounting to 20,000 for the financial year 31st December 2018. So basically, we have completed this exercise. And for 4.8, we will discuss in the live section. And last, advantages of limited liability company. Company is required to pay corporate tax and which is likely to get tax advantages. No restriction on the numbers of members. Members have flexibility in structuring the company management. Owners are not personally responsible for the debts and liability. So we call limited liabilities. Disadvantages: stringent rules and regulation to comply as compared to sole proprietor and partnership. Higher compliance costs in order to meet the regulation, such as audit of financial statement. Owner may lose of control in the company if they sell or transfer the share. And last one, restriction on dividend payment to shareholder to protect the creditor interest. So that's all for the limited liability company, chapter 4. And thanks for watching. If you have any question or comments on the video, you can comment in YouTube or you can ask me in LMS. So that's all for chapter 4. Thanks for watching.